Hello, everyone. Sorry for keeping you waiting. Welcome and thank you for attending the first Yield Development live market briefing dedicated today to the DRAM and NAND markets. My name is Camille Verguier. I am Marketing and Communication Director for Yield Development. Based on our memory monitors, the aim of this today live market briefing is mainly to provide you in 30 minutes an update today to analysts of the DRAM and NAND markets with a focus on the COVID-19 impacts. Our two experts today, Mike and Walt, both respectively VP of DRAM and NAND and memory research, will examine the changes to our market outlooks in the context of our prior forecast and what they see as the most likely outcomes during these very uncertain times. Before we get started, I just remind you that you are encouraged to submit questions to our analysts during all the live events using the Ask Question window at the bottom of the screen. Question will be answered right after the presentation, but in case we don't have the time to answer all of them, we will follow up with you by email. And to conclude, this live event is recorded, so you will receive tomorrow an email with the link to access the recorded version. So let's start the live market briefing, and please welcome Mike and Walt. Hello, sirs.
Hey, thanks, Cami. Good morning, everyone. Thanks for joining us. As Cami mentioned, Walt and I are going to provide an update today on the memory markets, both DRAM and NAND, and specifically contrast how we see the market today versus sort of how we saw it at the beginning of the year before COVID-19, before the pandemic hit us. To this end, we thought we'd structure today's webinar by addressing some of the major questions that we've been getting over the last few weeks and months to try and sort of frame the discussion. That's us. So the first question we're going to tackle is demand. Specifically, are there winners and losers coming out of this COVID pandemic? The short answer is yes. One of the big winners that we're seeing has been data center, and we thought we'd share a few anecdotes to illustrate this. Netflix is a great example. If we look at Netflix, over the last 8 years, they've averaged about 4.5 million new customers per quarter. But in the first quarter of this year, with much of the world on lockdown, we saw a huge spike in streaming media demand. The result is that in Q1 of 2020, Netflix saw about 16 million new users, more than 3 times the sort of 8-year average and 60% higher than their prior record. And it's important to remember that Q1 only had a few weeks of lockdown in it. So clearly, lockdown and COVID has been a boon for media streaming. Another example is gaming. If we look at Steam, which is the online gaming platform, we can see that over the 6 months prior to lockdown, it averaged about 16 million users per day. Since lockdown, that number has jumped to about 23 million users per day, nearly a 50% jump in demand. Also, it's kind of interesting that prior to sort of lockdown, we would see these weekly spikes in Steam usage, and that corresponds to the weekends, whereas since lockdown, demand has been much steadier, and we're not really seeing those weekend spikes in demand. Some other categories that have been driving data center demand include things like online shopping and, of course, the now ubiquitous Zoom calls, which are taking the place of face-to-face interaction as we all try to work from home. So there's quite a few tailwinds for data center demand.
Yeah, this is Walt. I'll just add, I think, one of the most important questions is whether this current surge in demand will be sustained over the mid to long term, or is this just a short-term phenomenon? My opinion is, I think online gaming and the media streaming services will see a slowdown at some point when people go back to work and the kids go back to school. This has really been an acceleration of pre-existing trends, around remote work, on-demand media, online shopping, et cetera. And I don't think those are going to reverse. Not everyone's going back to the office after this, and not everyone's going to abandon grocery deliveries and restaurant deliveries. So I guess long-term, these behavioral changes provide a lasting tailwind to data center demand.
Yeah, that's a good point, Will. So what does this mean for memory? So before COVID, we expected the data center to generate about $38 billion in memory revenue this year, with that revenue sort of about 55% weighted to the second half of the year. If we look at our sort of outlook today, it's shifted a little. We expect the revenue to be split a little bit more evenly, essentially 50-50 between the first and second half of the year. And really all of this surging demand for media and so on, it's changed those half on half dynamics for 2020. Cloud service providers have been big buyers thus far this year, as they've seen significant upticks in demand. And further, traditional enterprise has been scrambling really to figure out this work from home situation. So they haven't slashed budgets up until this point. Whether that persists is a different question. It talks about the second half. There's a lot of uncertainty about the second half. We expect traditional enterprise to reduce spending as the full economic impact of COVID is better understood. Additionally, although CSPs have been big drivers of first half demand, there's a little concern that shrinking ad revenues and just the general economic malaise will prompt them to cut spending as we go into the second half. So there's a lot of unknowns as we look at the second half of this year, but server and data center is still sort of the shining example of a winner for COVID-19. Another category which we're going to call a winner is PCs, which we think is a relative winner given the current situation. Pre-COVID-19, our forecast was for about $24.5 billion in total memory spend. If we go to our current outlook, it's down slightly. However, the category is holding up pretty well. We only expect PC memory spend to be down about $1 billion compared to what we thought 4 or 5 months ago. Q1 sales clearly much lower than we had anticipated, but much of this was due to supply chain constraints rather than a lack of demand. And for the most part, those constraints have been resolved, and we expect Q2 PC sales to be up quite dramatically. Clearly the whole work from home is what's causing this surge in PC demand as people realize that to get real work done, especially for an extended duration, you need the right equipment. You can't do it on your phone. But we think this is likely a one-time uplift in demand and not a systematic or systemic change to the PC market. Now, if we look at the overall year on our unit forecast, we've taken our PC unit forecast down about 1%. Even though we're seeing strong demand today, we do expect by the time we get to the second half, we're going to see a drawdown in demand as those economic headwinds really take grip of consumer spending, and the enterprise really looks to tighten up their budgets as they face, worsening economic conditions.
Yeah, maybe I'll just add kind of a NAND perspective here. Is much of this demand surge is coming from corporate buyers, and those are overwhelmingly SSD-based PCs. Another big driver right now is Chromebooks on the education side, and those also have pretty much 100% NAND-based storage. So I think the PC mix is pretty beneficial to NAND right now.
Yeah. So losers. Smartphone is one category that we would call a clear COVID loser. At the beginning of the year, we expected 2020 to be a really strong year for smartphones with lots of buzz around 5G. We expected new smartphone shipments to be right around 1.4 billion units and memory revenue this year to hit almost $40 billion, with that number growing to over $50 billion in 2021. Today, not so optimistic. We expect shipments to come in much closer to 1.1 billion units, and memory revenue to be down about 20% to $32 billion. Although we do expect recovery in 2021. This year, people's just inability to get out and actually shop for a phone during lockdown, couple that with the economic uncertainty and hardship that a lot of people are facing, people are just holding on to their phones a little bit longer and postponing buying a new one. But, when it comes to a smartphone, we believe that long-term the segment is going to bounce back. Phones don't last forever. Screens eventually break, batteries become unusable, and eventually old phones will need to be replaced. That's why we think there's going to be a catch-up in demand, which we expect to start seeing in 2021. And so as we look to 2021, we still expect a strong market, and we think that'll also bleed into 2022.
Okay, I think we're going to turn it now over to looking at some metrics around the memory suppliers. So the first question we're going to address is how are the memory suppliers reacting to the crisis? One of the first indicators of the supplier reactions is going to be what's going on with CapEx. Our pre-COVID expectations were for DRAM and NAND CapEx to be down about 15% year over year, coming in at almost $39 billion, and that includes both WFE and infrastructure spend. This decrease from 2019 to 2020 was expected. It's the result of the memory market downturn that plagued 2019 and much of 2018 for NAND. Just kind of thinking about the timing of infrastructure build-outs and technology transitions. Our current forecast assumes a much steeper 2020 CapEx drop-off. We now think combined memory CapEx is going to be about $33 billion this year, which is down 27% year over year and 14% lower than our prior outlook. We think the memory suppliers are going to be more cautious with investments this year, given all the uncertainty around second half demand and the longer term ramifications from the outbreak. I mean, basically, I think if I could sum it up, I'd say we expect the suppliers are going to err on the side of caution, and they're going to likely push spend that was, destined for this year into next year or even further, just depending on market conditions. And if you think about what that means for the memory markets, all else being equal, lower CapEx is going to translate to slower technology transitions, lower bit growth, slower cost declines. And those cost declines are going to flow through to financials, so you're going to impact supplier profit margins, likely going to have lower memory revenue TAM. That's kind of going to be dependent on how the average selling prices are impacted by all of this. Next, another indicator is that we can look at is bit shipments. First, let's take a look at DRAM. So our pre-COVID outlook, we assumed, or you can see here in the chart, the traditional seasonality of the market with fairly flat shipments in Q1 and Q2 before stronger growth in the second half. We expected full year bit growth for 2020 to be about 17%. If we look at our current forecast, we're looking at first half shipments coming in higher than anticipated, based on the strong server demand that Mike talked about earlier, as well as customer buy-aheads. We think those occurred due to some supply chain concerns. That's helped offset some of the initial COVID-related weakness in smartphone and consumer markets. We now expect second half shipments to be below our prior forecast as the impacts from COVID-19 intensify. So if you look at kind of our half over half bit growth that went from 16% previously, now we're looking at only 2% half over half growth. And our full year bit growth number is down to 15%. And looking ahead to the rest of the year, I think although data center demand is expected to remain reasonably robust, I think we anticipate continued weakness in the smartphone market, continued weakness in the consumer markets, and softening PC demand after this initial surge kind of wanes in the back half of the year. The demand for traditional enterprise servers is also at risk as the economic uncertainty is likely going to lead to more conservative IT spend. If we turn our focus over to NAND, prior to the outbreak, 2020 bit growth was expected to be somewhat constrained at 30% and heavily weighted to the second half of the year. And that's really because the market was coming off of a few really bad years, and there's impacts from previous year CapEx cuts that are now showing up this year. So CapEx cuts from 2018 and 2019 impacting bit growth this year. if we look at our current forecast and how that's changed, similar to DRAM, you can see that the first half bit shipments were resilient, but we do expect a little bit of weakness in the back half of the year. So now our second half bit growth is only 13%, with annual bit growth down to 28%. I'd say that the general demand trends that Mike talked about earlier and the ones I talked about for DRAM really hold true for both DRAM and NAND. But one thing I'll note about NAND is that it has the added benefit of the continued HDD to SSD replacement cycle in the PC and enterprise space, as well as the introduction of new gaming consoles later this year, which are shifting from HDDs to SSD storage solutions. And that's going to provide a pretty nice boost to bit demand later this year.
Yeah, one thing I'd throw in there, Walt, regarding DRAM shipments is I think it's going to be possible for suppliers to ship more than what we're calling out in our forecast right now, especially if they don't sort of trim CapEx and they keep production plans aggressive. So it's going to require some discipline on their part to make sure that production and shipments stay somewhat constrained or restrained so that they don't dramatically oversupply the market. But again, there is certainly risk with shipments that they have the potential via production and inventory to outship the numbers that we're calling out here.
Okay, yeah, that's a good point. I think the last thing we're going to cover here in the presentation portion is memory prices. So where do we expect those to go over the next 12 to 18 months? Again, let's start with DRAM. So after significant price declines in 2019, our pre-COVID model forecasted a strong pricing recovery beginning in the second half of this year and lasting through 2021. So full year pricing for DRAM was expected to be down 12% in 2020, but up a pretty dramatic 41% in 2021 as the market really went into a full-blown recovery. Our current forecast shows first half pricing coming in higher than our prior expectations. Again, that's led by server, but we do now expect weaker demand in the second half, likely resulting in flat to down pricing. I think the reality is the second half pricing is going to be largely dictated by the response of the suppliers to this pandemic, and Mike kind of mentioned that previously. Are they going to reduce production or continue kind of along the path of their prior build plans? And kind of the decision they make there is going to have a huge impact on what happens to pricing. As for NAND, before the outbreak, we expected the pricing recovery that had already started in late 2019 to persist through 2020. So we expected blended pricing up 6% year over year. We then expected an influx of supply in 2021 to cause oversupply and pricing weakness, with full year ASP declines of about 25% next year. Looking at our current outlook, like DRAM, first half pricing has been higher than expected, but second half pricing will likely come in below our previous expectations, but not by too much, as NAND has that added benefit of the new gaming console releases that I mentioned last year, as well as the continued HDD to SSD transitions. Net, our current outlook is for blended NAND pricing to be up 5% this year. And I think I should also mention that the downturn that spanned most of the past few years, it's pushed industry profit margins for NAND into negative territory. So looking through 2019, margins were negative for most of the NAND suppliers. And although margins improved in Q1 and even moved positive for most of the suppliers, they're still operating on very thin margins, and there's not a lot of room for big price declines in the coming quarters. You also need to think about the CapEx cuts that we expect to happen now as a result of COVID-19. Those are going to impact the ability of the suppliers to reduce costs, both later this year and next year. So as a result, we've actually kind of increased our 2021 assumptions a little bit, just because there's not enough room on the margin side for pricing to fall too dramatically. So we're now looking at blended prices down about 18% year over year in 2021. So yeah, I think now we'll wrap that part up and move on to Q&A.
Yes, thank you very much, Mike and Walt, for your kind presentation and your time. So we received, of course, many questions. Maybe the first one would be on their earnings call, several suppliers talked about strong server demand and how they expected to keep the DRAM market strong through 2020. How do you reconcile that with what you've just presented?
Yeah, okay. So I was, listening to earnings calls this quarter. I was a little bit surprised to hear those comments, especially considering the amount of unknown out there, that there would be such a sort of a clear message that, they anticipate strong second half server demand. And that's not to say that we expect server to be exceedingly weak in the second half. We don't, but we do view the current dynamic as one wherein, we've seen CSPs pull in demand we believe from second half into first half. They've seen, cloud service providers have seen a surge in demand. They've pulled ahead orders to build out capacity. But I think on their part, as we mentioned, there's some concern there that some of this demand might be transient. We're not all going to stay at home and play games for the rest of the year. Folks are going to end up going back to work and back to school. So does that demand, that end demand sort of remain there? Second, I think traditional enterprise is going to face some tough times as we go into the second half this year, and there's going to be some belt tightening and slowing in spend. Again, that's not to say that server is going to be dramatically weak. We just think that we've seen a pop in the first half that is not indicative of a growth rate that we're going to see continue through the end of the year. So you put these two things together, and we anticipate an overall sort of slowing of growth. Sort of slightly unrelated, but completely related, is you've got to think about the overall DRAM market. Coming into this year, there was first half of this year, there was a lot of wafers that were going into mobile. Now that's a wafer start decision, and so with cycle times, call it a quarter. When suppliers saw the mobile market deteriorating rapidly, they started changing those wafer start decisions and shifting bits out of mobile and into compute. Well, we're going to start seeing those wafers come out of the back end here in the next month. And so we're going to see a lot more availability of server and PC product, which, that's going to adjust the supply-demand balance. But look, server's done exceedingly well this year so far. We came into this year with the 32 gig module at, call it $100. Today we're sitting at, over 140. That's a huge jump in just a few months. But, given the market dynamics, that sort of demand dynamics that we've described, I think it's unlikely that we're going to see server prices continue on that same trajectory. There's a good chance they're going to be flat to even down slightly as we go through the rest of this year. Especially, as I said earlier, if suppliers don't sort of very conservatively manage their production and shipments. So we are less optimistic than the comments on those earnings calls, although we do expect server to have a decent back half of the year.
Mm-hmm. Okay, thank you. We have a second question that is, how does COVID-19 impact new entrants from China? We are thinking about YMTC and CXMT, for example.
Yeah, this is Walt. I'll take this one. So I guess I would say at a high level, I think, the Chinese government may actually be emboldened by this to, there's been a lot of, I think, rising global tensions between China and the U.S. and Europe. And they may be emboldened to help ensure the success of their homegrown memory suppliers. So that's just sort of a maybe high-level comment. But I guess specifically to like YMTC, what we're hearing, I think there's been some impact early this year, but things do seem to be normalizing. For example, I think there were some equipment deliveries delayed due to the January lockdown, but recently those equipment deliveries have resumed. I'm not sure about CXMT, but I did hear that YMTC, they received a special exemption to continue operating during the height of the COVID lockdown in Wuhan. Some of the concerns we've heard around the ramp-ups are kind of around the equipment vendors and not being able to necessarily support some of the equipment installs. But I think the suppliers there in China are working around that. First, the major equipment vendors have local offices with local employees to support the equipment installs. And then if they need assistance from people, that can't travel to China, they can use video chat and other means to try to get assistance. Now, that's not ideal, but I think it's been workable. There may be some bottlenecks with the smaller equipment vendors who don't have local support. We've kind of heard anecdotes around that, but again, I think there's creative ways to get around that using video chat and things like that. So net, I think the impact, at least on the YMTC front, is going to be a slight delay in the ramp up. So we'll probably see lower wafer output this year than we would have otherwise, maybe a 1 to 2 quarter delay relative to our prior expectations. But I don't think it's going to have a major impact longer term.
Yeah.
Okay.
And I'll just quick comment on CXMT. Clearly, we don't believe this has accelerated their timeline. That would be unusual. Rather, we think that there are enough other challenges that they face that are much larger in magnitude that this is sort of a second order sort of impact on their production schedule. So yeah, it's certainly going to slow things down, if anything, but we think that they're facing enough challenges from other areas that those are going to be much more impactful than COVID-19 will end up being.
Okay, so we will all monitor that.
Yes.
Maybe we have maybe a few minutes for last question. Does the 2020 capex cut have a bigger impact on WFE or shell spend?
You want to take this one, Walt?
Yeah. So I think, at a high level, I would say, well, I guess first I'd say that the past year or two, there's been significant build out of infrastructure. So the weighting of WFE to infrastructure, although still a greater percent is WFE, it's been probably heavier weighted to infrastructure than usual. So you can think about, all the memory suppliers and the fabs they've built out. So you have Samsung, Pyeongtaek, there are 2 fabs there, Kioxia and WD building out a new shell in Iwate called K1. SK Hynix has M15 and M16. Micron's been expanding in Singapore. I think I covered most everybody there. So all the suppliers have been adding shell space. And now this was going to be a year to really start equipping those shells and to continue those ramp outs or build outs. So we were expecting 2020 CapEx to be more weighted to WFE than usual, up in the range of, 80-90% of CapEx, if I'm looking at it, rough numbers. But so I think when we talk about the impacts from COVID and impacting 2020 CapEx in particular, it's going to be heavily weighted to the WFE side because that's where most of the spend was going to be this year anyway. I do think there's a few ongoing shell builds. I think Hynix's M16 is one example. I think we'll see that continue without delay. But yeah, I think generally this is going to be more impactful to the WFE side of the CapEx.
Yeah, I mean, any construction that's going on right now, we believe is generally going to continue. But as demand the demand picture worsens, it's more likely that we'll see that cut in WFE. But yeah, coming into this year, we did expect WFE to have a pretty sizable chunk of overall CapEx.
Okay, well, thank you very much, first for your answers to these questions. So now the live market briefing is ending. Once again, I would like to thank you, Mike and Walt, for your time and analysis, definitely linked to the current situation. To everyone, you will receive soon an email with the link to the recorded session within 24 hours, not more. But please note the presentation is already available and can be downloadable from the resources section of the platform, so it's on the bottom of your screen. Feel free also to share the presentation with your colleagues or send them the link to access the replay. And finally, let me remind you that you can find all our reports, monitors, and many more on our website, iMicronews. So it's i-micronews.com. Now, do not hesitate to contact us if you have any questions. You can find all our details on the last slide of the presentation. Once again, thank you everyone for joining us today. Have a good day and take care.